Good morning, ladies and gentlemen. Today is the 25th of March. It is a Friday, and the time is 10:40. So, as of now, couple of things here. First of all, today exited my trade at 1 point below break-even. So, my intraday trade, I exited at 17,000 loss. After that, I've entered a double diagonal trade, and my market will show a little bit jumpy plus minus. That's because these April month hedges that I purchased, they are not very liquid. So while the bid ask might be 5-6 points apart, the LTP will show wrong. But currently my position is in a the double diagonal is more or less flat, and the intraday trade I've booked a 17,000 rupees loss. So couple of things to address. What happened today? What was my trade hypothesis? The thing is, last night, if you look at what happened to the S&P 500, the S&P 500 VIX crashed by 8%. It's a huge amount. There's a massive fall in the expected implied volatility over multiple expiries. So what I expected was the same will more or less percolate into the Indian market, at least to some extent. And what I was looking at to short in the morning was this 16,800 and 17,600 strikes, which yesterday they closed for around 130 rupees. This morning, 8% VIX crush, you have to keep in mind. They opened for around 111, 112. And I was like, okay, you know what? Perhaps there can be like a quick IV crush. And in case there's not, let me take a little bit more credit. So from the opening level, I was closer with my call side. Little more credit from the call side, so that the negative delta of the position and plus provided there's an IV crush will benefit. So I'm balancing the idea, saying that okay, my position is protected against a slight down move because I have more call side credit on the options that I'm shorting, and also the premiums are opening 20 rupees cheaper than yesterday. But you have to keep in mind the US session that we had and the kind of VIX fall off that happened in the US session. So that's how I built what I'm going to trade today. So what happened is, right after we opened, we had pretty large red candle, and quite immediately the put options, which I shorted at an average price of 50 rupees. Okay, so 50 rupees is what, if you see here, you can see my average price is 50 rupees on the put option and 61 rupees on the call option. The put options went up all the way till 70, and the call options didn't really give up too much. So it was a very bad entry. Within the first 5 minutes, at one point, I think I was down close to 8 points, 7.5, 8 points. And there in itself, the potential opportunity for the rest of the day was removed. After that, we had a little bit of a cool off as the market had this pullback. And my idea was, okay, I have to trail to cost. So once this particular candle was formed, my cost price was hit and I had to exit. Okay, wow, some big candles forming there. So since my position is IV positive, this put option should give me a good amount of protection. I'll go into what the double diagonal trade is. The liquidity on this is not so good. Okay. So you see, despite that candle, my delta neutral position more or less is doing all right because I have the protection of this monthly April 16,600 put option. I'll get into the specifics of that trade, but basically I had to get out here, and naturally one can see that if I hadn't gotten out there, been not the best situation. 1 second. Okay, so how did I come up with the strikes? Obviously, I want to sell around below this, being a Friday, and above this, and more or less balancing for premiums 16,800, which is this tremendous support. Once we broke above that, it has acted as a support. So 16,800 is where I'm selling my put option, and 17,600, which is one strike above 17,500. Regardless, that trade didn't work out because it went straight into a negative. After that, it came back to break even, and my idea was I have to exit worst case also at break even, and I exited basically 1 point below break even, which is acceptable. Now what have I done? I have taken a double diagonal trade, which is I have shorted the strangle of 16,900 and 17,600. 300 points on the upside, 300 points on the downside from 17,200, and purchased April month hedges, which are 300 points away. So 300 points away on the put side, 16,600, 300 points away on the call side, 17,900. And the idea here more or less is that as long as there isn't a tremendous IV crush, which there doesn't seem to be, and even if there is enough premium in my short position to be so that the theta will balance the IV crush. See, my threat is that these long options might lose a lot of money. Now, to avoid that, I have almost 130 rupees in credit in my short option. So as long as between these two they don't lose more than 100 rupees in a matter of the next let's say Monday and Tuesday, then I will be quite comfortable. This has to lose basically 25% of its value, or either of these strikes getting breached. Now if these strikes look to get breached on the downside, why do I have so much more credit? Because naturally when we make a down move, IV will go up, VIX will shoot up, which means this position will benefit, because this position has a, if you look at the Greeks of this position, this is Vega positive, which means if IV goes up or India VIX goes up, this trade will make a profit. It will actually benefit from that. So that's why it is Vega positive and delta wise also a little bit positive, which means that in case there's an up move, I'm expecting India VIX will crush. So if we go to 17,300, India VIX will crush, which means these two options, which are long IV, they are purchased options, they will lose money for me. And that time I want to ensure that my short put has more credit than my short call. I hope that is making sense. And this is more or less what the trade is. I have done a double diagonal trade 2 weeks back also. I made a Twitter thread on that. I posted all the updates there. So you can reference that for exactly what it is that the trade is, where I will manage it until 17,000 is broken, or until 17,400 is broken. I'll not be making changes to it. So today, and see, one more thing that plays a big role here is position size. If you see what is my margin used, it is this much. So it is a very small portion of the margin that's available to me. And that way I kind of make sure that, okay, even if, worst case scenario, like what is the, this max loss is purely hypothetical, but worst case scenario also, I will ensure that this even like 20% of this will be the worst case scenario. So that is more or less the trade that I have taken. I have some trades which is short calls on Reliance, which is bleeding, short calls on ITC, which is bleeding. I don't have to worry about those trades because they are completely covered. They're completely hedged by my stock holding position. So in case, they go at the money, I will manage it accordingly. There is no rush to be able to fix that in any way. So I will keep you posted on that as well. In fact, if we head up, my idea is I'll be entering even more short call positions against some of my other shares. So that is also there. Now, one question that's coming up: why are you trading Fridays? Because Fridays clearly lately, at least the last month, the case has been whatever crush in premiums has to happen is happening overnight. And then if you're entering a position, let's say in the first few minutes of the market, it is a good chance to give you quite a bit of a negative. So why trading Friday? So I'll put it this way. If you look at Friday performance, right? So if you look at what has been the situation with Fridays, yes, past few Fridays have not been so good, but overall speaking, Fridays have been good for me. And if you were to tally all of my Fridays, you will find that the net losses versus the net profits, I'm on a net gain. It's a minor net gain. It's not as good as some of the other days, but it is in a substantial gain itself. So that's why I still trade Fridays. That's why I still trade Fridays the same way I did previously. Also, at a point where Fridays are non-stop wins, and it's good profits also on Fridays. So that's why I continue to trade Fridays. Many people said, why don't you just skip Fridays? This is the reason for it, because if you really think about it, okay, last Friday booked a loss. The Friday twice before that I booked a loss. But if you tally all the profits from the Fridays before that, it works out to overall very positive. So that's the idea. And yeah, so One more thing that I want to point out, which is a little bit different, and you won't have heard this anywhere else about the double diagonal trading, is right now I have a double diagonal trade open. Now I know that this will be double diagonals are the most versatile trade. It can be managed any which way, and it's not going to give you a surprise. Oh my God, tada, massive loss. It doesn't do that. That's not in the nature of the trade because it's IV positive. Yes, if there's some massive IV crush and literally these short options which are expiring more than 1 month away lose 25% overnight, it can give me a loss, but still, really speaking, substantially, I don't think that that is a possible scenario. So what this trade does is, if I'm not trading rest of today, I don't want to trade rest of Friday on intraday trade. I have a trade open so that call it sudden desire to be in a trade, or oh my God, am I missing out? The FOMO factor gets eliminated by the fact that you do have a trade running. Yeah, but it's mark to market will move very slowly. See, the thing is, in a double diagonal, your mark to market doesn't shift very quickly. It shifts very slowly, and it takes its own sweet time. And the idea is it gains from theta decay. It gains from IV increase, but it won't be like, okay, you're at 15,000 now, you're suddenly going to, I mean, you're 2 points negative or 1 point negative, suddenly it's going to jump to 10 points positive, 5 points. It doesn't move that way. So that gives you the satisfaction that you're in a particular trade, first of all. And secondly, it is an apt trade to have at this point of time. If you see, spacing also in double diagonal is important. If I'm spacing, let's say 150 or 200 point away hedge, then my IV positivity goes up huge. The Vega in this position would not be 1.2 lakh, it would be around 2 lakh plus if my spacing was 200 or 150 points away from the spot. So that also is kind of taken care. And yeah, that's about it. If I make any updates to this trade, I'll probably post on Twitter. But this is the summary of the day. Basically, entered not such a good trade, not such good prices, so had to take the exit when it was at break even. Didn't have any risk appetite after I know that I got cheesed on the entry. So thank you so much for watching. Have an awesome weekend. I will catch you next week. Take care. Have a good one.